Disclaimer. This is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. All right, let's get right into it. Everpure stock just went on a truly wild 7-day run. If you track the AI storage sector, you know this ticker has been on absolute fire. But as an equity research analyst, I don't care about the hype. I care about the footnotes. Let's look past the sheer price action, because we want to know exactly what's driving this massive breakout. Is it just Wall Street pumping a narrative, or is there a rock-solid fundamental shift happening beneath the surface?
Over a relentless 7-day winning streak, Everpure delivered a staggering 41% cumulative gain for its shareholders. Look, this wasn't just a gradual climb. This was an aggressive vertical spike that pushed the stock to a brand new 52-week high of $118.16. When a stock moves like this, it immediately commands the retail market's attention, but it also triggers my skepticism. I want to see the receipts.
To put that percentage into perspective, this single week of trading added an unbelievable $11 billion to Everpure's total market value. They're now sitting at a market cap of roughly $39 billion. And if you compare that to the broader market, it leaves the S&P 500 completely in the dust. Over that exact same 7-day period, the S&P 500 managed a meager 0.8% return. So this was absolutely an Everpure-specific event.
Section 1. The Billion-Dollar Catalyst. We are breaking down Q4 and fiscal year 26 earnings.
The match that lit this powder keg was Everpure's highly anticipated earnings report. And honestly, the sheer scale they've achieved here is pretty incredible. We're looking at their first ever billion-dollar revenue quarter. Q4 hit $1.1 billion, up 20% year over year. For the full year, they brought in $3.7 billion, a solid 16% jump. And importantly for us, investigative geeks who care about actual cash generation, they delivered $201 million in free cash flow for the quarter and a massive $616 million for the year. This isn't just a paper profit, this is a highly cash-generative machine. But to understand where they're heading, we need to look at their pipeline. That brings us to RPO, or Remaining Performance Obligations. Simply put, this represents the total value of all the contracts customers have signed for future services that Everpure hasn't delivered or recognized as revenue yet. This is a massive signal because it tells institutional investors exactly how much locked-in future business the company has secured. And here is the number that really turned heads on Wall Street. Everpure's RPO grew by a massive 40% year over year, hitting $3.7 billion. That is essentially an entire year's worth of current revenue already locked up in future commitments. This shows us that enterprise customers aren't just buying a piece of hardware and walking away. They are locking in long-term, sticky commitments.
Section 2. The Enterprise Data Engine. Let's look at their strategic shift.
So why are enterprise customers suddenly so willing to sign multi-year contracts? This quote from Hyperframe Research hits the nail right on the head. Everpure is transitioning from a basic storage infrastructure provider into a persistent enterprise data platform. As AI workloads demand continuous, uninterrupted access to massive datasets, Everpure is positioning itself as the critical software-driven engine that manages all of it across both on-premises environments and the public cloud. And this visual brilliantly illustrates the financial reality of that shift. Their subscription annual recurring revenue, or ARR, has now climbed to $1.9 billion. That's more than half of their total $3.7 billion revenue pie for the year. They are successfully converting traditional one-time hardware buyers into recurring software subscribers. And as we all know, software revenue commands much higher valuations in the open market.
They're aggressively reinforcing this platform shift with strategic moves, like their pending acquisition of OneTouch. Now, before we get skeptical later, I dug deep into their 10K and I uncovered 7 green flags buried in the footnotes that prove this shift is working. The 7 media blackout green flags. First, deferred revenue is growing much faster than recognized sales. The media ignores this because they focus entirely on trailing headline revenue, not the pipeline. Second, they have massive net operating loss carryforwards shielding future taxes. Tax accounting is just too unsexy for primetime news, but it saves millions in cash. Third, supplier concentration is actively decreasing. Supply chain footnotes are tedious to read, so analysts skip them, but this drastically lowers their operational risk. Fourth, they have a remarkably high patent citation index in data duplication. Intangible assets like this don't neatly show up on the income statement, so they're completely ignored. Fifth, we're seeing declining CapEx intensity with stable output. This gets missed because it requires calculating return on invested capital over a 5-year smoothing period. Sixth, there's significant insider buying by non-C-level directors. This positive signal is usually overshadowed by headline-grabbing CEO sales. And seventh, extremely high customer switching costs are locking in platform retention. This is hard to quantify without reading dense customer cohort data, but the stickiness is real.
Section 3. The NAND supply squeeze. Time to uncover the hidden asterisk. It's really easy to get caught up in the momentum, but as an investigative analyst, we have to look for the dirt. To understand the immediate risk here, we have to define pull-in demand. Right now, there's a global shortage of the NAND flash memory components that Everpure uses to build its systems. Because of this shortage, component prices are skyrocketing. In response, customers are panicked. They are placing huge orders for storage right now, way earlier than they actually need them, just to avoid paying higher prices later.
So these shortages create a dangerous dual reality. Yes, it's a short-term win, driving nearly a third of the recent breakneck revenue growth. But the long-term risk is severe. If customers buy all their storage for the next 2 years today, what happens to your demand tomorrow? You risk a nasty hangover. In fact, digging into the working capital footnotes, I found some major concerns. The 7 media blackout red flags. First, inventory turnover is actually decelerating. The media ignores this because it requires digging deep into working capital schedules. Second, there's a looming goodwill impairment from past acquisitions. They ignore this because it's a non-cash charge buried way back in the footnotes. Third, days sales outstanding, or DSO, is rising. It's just too complex for a quick TV soundbite, but it means they're taking longer to collect cash. Fourth, we see negative free cash flow conversion relative to GAAP net income when stripping out stock-based compensation. The media loves headline EPS and ignores the stock dilution. Fifth, executive 10b5-1 plan sales are accelerating. Analysts dismiss this as standard portfolio diversification, but insiders are cashing out at the top. Sixth, product gross margins are visibly dropping. Management spins this as strategic pricing, so the media eats it up. And seventh, shrinking R&D efficiency. Capitalized software costs on the balance sheet are hiding the true cash burn.
Expanding on that margin point, to maintain market share and keep their customers happy during the shortage, Everpure is intentionally absorbing some of these component price hikes themselves, rather than passing 100% of the cost onto the buyer. Because of this choice, their product gross margins actually dropped by 180 basis points in the quarter. They are literally trading margin for market share.
Section 4. Valuation reality check. Is this massive rally actually justified by the math? We have to weigh this incredible, subscription-driven AI growth narrative against the cold, hard reality of their stock price. When we look at the S&P 500 comparison, Everpure's 21% top-line growth is a beast, but their operating margin is a razor-thin 4.2%. So it's time for the ultimate valuation gauntlet. I ran the numbers across 21 distinct models based on their current fundamentals. Group A, cash flow and discounted. Standard DCF, using their current weighted average cost of capital, yields an intrinsic value of $85 per share. Unlevered free cash flow models come in at $82. Free cash flow to the firm, comparing it to enterprise value, yields $80. Free cash flow to equity, measuring true shareholder value, is slightly higher at $88. And the adjusted present value, factoring in base case plus tax shields, lands at $84. Group B, dividend and income. Standard dividend discount model, basically irrelevant here, but yields $40. Gordon growth model for perpetual growth sits at $42. A multi-stage DDM for their high growth into a terminal phase hits $65. Residual income model adding book value to excess earnings gets us $55. An economic value added pitting operating profit against their capital charge points to $50. Group C, comparables and multiples. Comparable company analysis against sector peers gives us $105. Precedent transaction analysis based on historical acquisition premiums hits $115. Trailing and forward PE multiples suggest a fair value around $70. Price to book based on sector averages is a lowly $45. EV to EBITDA valuations point to $90, and EV to sales implies an optimistic $120. Which brings us to the elephant in the room. Their current PE ratio is a staggering 172.9, while the stock trades at $118. Let's finish the gauntlet and see what the investing legends would do. Group D, balance sheet and asset-based. Standard book value is just $22 per share. Net asset value, taking market value assets minus liabilities, is $25. A fire sale liquidation value is merely $15, and replacement cost to rebuild this business today is about $35. Group E, advanced and options.
Finally, using real options valuation, applying Black-Scholes logic to their future AI pipeline and R&D expansions, we get $95 per share. Legendary investors reality check. So, would the greats buy this? Ben Graham? Hard pass. The Graham number completely fails here because the PE is massively over 15 and the stock is trading miles above its net current asset value. Peter Lynch? He'd walk away too. Calculating the PEG ratio by dividing this astronomical PE by their growth rate shows it dramatically fails the Lynch fair value test. What about Warren Buffett? If we calculate owner's earnings by taking net income plus D&A minus maintenance capex, it's growing, but not fast enough. Their return on invested capital is decent, and net debt to EBITDA is manageable, but Buffett would never stomach paying a 172 multiple, even for a great business.
But to be fair, Wall Street doesn't seem to care about value investing right now. Analysts at Wedbush recently stated that Everpure's full-year 2027 guidance actually looks severely conservative. They believe that sustained high pricing, coupled with massive hyperscaler AI demand, will push this stock even higher, slapping a 127 price target and an outperform rating on the ticker. They are entirely focused on the momentum.
So, let's bring it all together into a final verdict. Based on the average of all 21 models in our ultimate valuation gauntlet, the intrinsic value of Everpure averages out to roughly $70 per share. With the stock currently trading near $118, the stock is unequivocally overvalued based on current fundamentals. The market is pricing in not just perfection, but several years of flawless execution in an incredibly volatile macro environment. However, we have to acknowledge the business quality. Defining their economic moat using Morningstar's framework, Everpure possesses a rapidly expanding moat. Their shift to a persistent enterprise data platform is creating massive intangible assets through software intellectual property and incredibly high switching costs. Once an enterprise integrates their entire AI data pipeline in Everpure's architecture, ripping it out becomes a logistical nightmare. Looking out 3 years, this moat is definitively expanding, not shrinking. The models are pointing one way, suggesting severe overvaluation, but the underlying business transformation and hidden green flags show a company building a formidable, cash-generating monopoly in AI storage. So, with pull and demand temporarily inflating sales and a 172 PE ratio staring us in the face, are we looking at a foundation of stone or a house of cards? The models are pointing one way, but hidden flags suggest a storm. Which side are you on? Do your own homework, dig into the filings, and I'll see you in the next explainer.